Hello, everyone, with another episode of Stable School Podcast, live from Cannes. I'm your host, Raza, head of growth at Scroll, and I'm here today with Rob.
Hey, thanks for having me.
Rob, please introduce yourself. Tell me what keeps you busy in the space.
Yeah, so Rob Hadick, I'm a general partner at Dragonfly. I'm about a $4 billion crypto fund, mostly focused on venture. Specifically, what excites me about the space? Well, I've been doing a lot of investing specifically in around stablecoins, payments, market structure more broadly, tokenization, a little bit of DeFi. That's really where I spend most of my time. And I think probably what you mostly want to talk about today at Stable School.
Yeah, and we'll get into all things stablecoin.
Yeah.
Double clicking on you, what attracted you to the crypto space? Like, what's a little bit of your background? Like, why crypto?
Yeah, so I guess it's 12, 13 years ago now. I was an analyst at Goldman, and I was mostly covering fintech. And this is the early days of kind of the fintech boom, coming right out of the global financial crisis. And we were seeing this trend of essentially like unbundling of the bank, where the bank itself wasn't serving all of the needs of a lot of underserved communities, underserved verticals and affinity groups. And you started to see a lot of consumer fintechs get started. And that's what I was covering. And it was really exciting to me. It was really interesting to see people try to provide better experiences for financial services, globally and in the US. And at the same time, I got introduced to Bitcoin, right? And so this is, 2012, 2013. I thought, okay, like Bitcoin is pretty interesting. We're talking about this within the context of fintech. That's pretty interesting.
Was it an aha moment, or was it something like you just glanced over?
So I kind of glanced over it. So, at the time, frankly, like the people I knew using Bitcoin were mostly using on like Silk Road.
Yeah.
I was a young guy in New York. But what ended up happening is during my time at Goldman in 2014, 2015, Bitcoin ran up and people like Goldman started to care. And if you remember, I think JP Morgan, this woman called Blythe Masters, was actually on the front page or the cover of Bloomberg Business Week at one point. And she said like blockchain, not Bitcoin. And this is like 2015. And there was just this boon and like people being interested in like, oh, can we use blockchain rails to like tokenization? And in fact, when I was at Goldman, I ended up being on the first working group to thinking about it. And we actually invested in 2016 in a thing called Exani, which was the first put high yield credit on blockchain rails, like startup, all the way back. This is a decade ago. And so that was what really got me excited. But my aha moment was really with Ethereum and smart contracts. And when we started to see DeFi evolve, and that was when I was interested, because I was thinking like everything I know can just be made so much better if it comes onto blockchain rails and through smart contracts and through essentially DeFi.
You don't have to answer this question. That initial project that you saw take off, is it still around, or?
It's still around.
What?
Yeah.
A decade later?
Yeah. How well they're doing, I do not know. But it exists.
That in itself is a track record.
Well, it's like a bank consortium. Bank consortiums can never die.
I come from TradFi, banking and insurance. I know all about that. So, okay. You're based in New York.
Yes.
What's the latest like on the scene? And I have a very specific question, because most of my friends, they're all like going to New York because they're like, Raza, it's happening here. Everyone woke up, stablecoin mania, events happening every week, conferences popping off. What's the latest in New York?
Yeah, I mean, I think it's the global epicenter of crypto at the moment, right? You look out over, back, if I go back to like 21, right, and the excitement about crypto that happened that year, there was a lot of interest in places like New York, financial hubs, right? And, a lot of the capital, a lot of the talent started coming out of banks, started coming out of, high frequency trading shops, started coming out of traditional funds. But it was at the time a still very global ecosystem where like most of the flows, if you actually looked at the trading flows, were all in Asia, actually, right? And so you had this this interest and this capital coming from the US, and then a lot of the flows coming from Asia. And that kind of remained to be true, especially after what happened with Luna and what happened with FTX, and the US administration got pretty hostile towards crypto. And at that time, it started to be very clear that being in the US was a potential liability in terms of innovation and in terms of just like we had founders being concerned that they, for just trying to build a new primitive, were going to be, potentially prosecuted, right?
As Dragonfly, you were concerned.
So we were concerned for our portfolio companies.
Yeah.
I wasn't concerned for us personally as venture capital investors. We're SEC registered RIA. We were within the bounds of the law, but I was concerned that, we had DeFi founders who, like, I know were trying to do everything possible to go and, make sure that they were within the law but they also wanted to innovate. They wanted to build a new global financial rails, right? And what we heard from places like Consensus and others, that they would have meetings with the SEC and they think they were going in to teach, and then it would seem more like an inquisition, or and then they would get a Wells notice.
That's scary,
right? And that's really scary, right? And that really flipped on its head, call it a year ago now, right? It became very clear that it was a bipartisan issue, that they needed to bring innovation in crypto back to the U.S. We had the passage of FIT 21 in the House, call it May of last year, so a little over a year ago. That's kind of laid the infrastructure for the Clarity Act, which will hopefully get a vote later this year. Obviously, there started to be talk about a stablecoin bill, which we've now seen pass the Senate.
Genius Act.
Genius Act, exactly, which is now in reconciliation in the House. And so, and then people started talking about it on the campaign trail. So it wasn't just, Donald Trump and the Republicans. It also started to become, Kamala and Joe Biden and others. And so it became very clear that, the U.S. was going to start to be a place to try to innovate again. And the second that we see that play out, and, after the election, and after the SEC and the CFTC has become more friendly and wanting to work with the space, everybody just moved back to New York.
It pretty much it's wild. I think as soon as the administration took place, it was in power, everyone was like, it was a sign of relief across the industry.
Yeah. 100%.
It almost seemed like there were some limitations that everyone felt and was taking into consideration in every action. And then it was gone. And as a matter of fact, I was actually in Korea at a time, and I did a talk. I think that this actually is healthy for the entire space, because what you're seeing right now is that Asia was already moving slightly faster in terms of regulation, providing clarity and a home for these founders. And instead of backing down, they're just going even faster. So I think that definitely it was very much a welcoming development. But double clicking on New York, slightly, because I hear this often, and I have I can understand what people mean with it, but what do you mean when you say financial hub, and what does it mean for stablecoin adoption?
Yeah, I mean, when I say financial hub, right, there's more money moved through companies that are centered in New York than anywhere else in the world. Yeah. Right. And what does that actually mean? You look at the largest investment banks in the world who broker, originate, structure, most of the world's, or a lot of the world's credit, a lot of the world's derivatives, right? That happens in New York, right? The equity markets, NASDAQ, NYSE, right? The largest equity markets in the world, they are there in New York. The largest funds are in New York, both trading firms and kind of credit funds and, long shorts, et cetera, right? They are all in New York, right? And there's London is also a financial hub. Hong Kong, has historically been a financial hub. Singapore trying to do some work there as well. But the biggest density of talent and the biggest density of just capital sits in New York. Right. And with that being true, and if I really think about what stablecoins are, it becomes very clear that people want to innovate within and in and around that talent. Right. And they want to be able to, and they want to understand the use cases, then you need to be dealing with the people that are actually sitting in that city. And so it used to be true when I covered just fintech that I was actually I was living in New York, but I was going to San Francisco all the time. And San Francisco was the kind of the hub of fintech. And you see, companies like Visa and PayPal and a lot of and Stripe and a lot of the history of e-commerce payments has happened in Silicon Valley. And there was a bit of this switch during COVID where a lot of people left San Francisco. And in fact, we actually used to have an office in San Francisco. We no longer do. And those people, by and large, actually settled into New York because New York was seen as just a better place to live during those COVID times and coming right out of COVID. And it stayed, right? And so, if you want to be in AI, you still got to be in Silicon Valley. If you want to be in financial innovation, New York is now the hub, right? And what are stablecoins? Stablecoins are essentially the base layer for a on-chain programmable financial ecosystem that is going to be global and that is reinventing the way that we do things across all of finance, right? And if you're doing that, and if that's what you're inventing, then you need to be at the place where all of the capital is flowing.
So what is Dragonfly's strategy and thesis around this? Maybe starting with thesis and then like strategy. You already spoke about the geolocation. So being there is obviously important, like just being physically there. But yeah, the thesis and then the strategy for their Dragonfly.
For being in New York or in stablecoins?
Stablecoins, and then if you could link it to New York, because I'm personally very fascinated about it, but I heard like actually a lot of people, because there's a reason people move to New York, like capital being there, cool. How does it flow into the ecosystem? Density of talent. How does that impact innovation? And then ideally, like, how do you guys view it?
Yeah. So I'll start in the city part first, right? And if we look at the history of most innovation that's happened in the U.S. And this is more of a U.S.-centric view, but most of it has happened in Silicon Valley, right? And what is the reason for that? That's because that's where all the engineers were. That's where all the capital was. You could go to a party at any given night, and you would bump into somebody who was starting a new company, who was doing something new. You could hire more easily. You could get connected with capital more easily. And there's just this sort of osmosis that happens when you're surrounded by people who are like-minded, who are working hard. And
network effect.
It's a network effect, right? And that Silicon Valley network is a big part of the reason for the success of software, right? Like those things are linked, right? And so when that happens, you can just bump into people and things can happen much more organically than, if you're in different parts of the world. I would love to live in Cannes, where we're sitting right now. You look at the weather, it's beautiful. There's the beaches, but I have to get on a Zoom call every time that I want to talk to somebody. And I will tell you, like that has to be, that's efficient in terms of like time, because you can put them back to back to back, but it also has to be very deliberate. Like you don't have organic meetings, right? And that organic capability of being around people, like that just leads to like just more innovation than as much as anything else, right? And so, so what does it mean for stablecoins? Well, Dragonfly actually organically moved to New York. It wasn't a conscious effort. So I'm the newest of the 4 GPs at Dragonfly. I actually only joined at the start of our 3rd fund. We're now on our 4th fund. My other 3 partners have been here closer to the beginning since of 2018 when we started, and I was in New York. And the reason that I ended up joining and that that Haseeb had wanted me to join, who's our managing partner, was because I had this traditional underwriting experience. I had been doing fintech before. I understood the linkage between traditional financial markets and crypto. And I was like, listen, like I'm not leaving New York. Like I know that like what I'm interested in, what I think is happening is going to stay here. And so I'm going to start an office here. I'm going to hire a team here. But then, I'll come to San Francisco sometimes or whatever. And what ended up happening is that one of my other partners, Tom Schmidt, actually just decided that he wanted to move to New York completely organically because he saw the talent flight, right? And he realized that like a lot of his friends, a lot of his network were moving to New York. And so he moved. And this ends up becoming kind of like a snowball, right? And like everybody starts moving. And then we had another one of our mid-level guys, one of our principals, same thing, right? Like, and it happened like very organically. All of a sudden we had like, like a 4th of the firm was like sitting in New York, right? And so then we just, like, it made complete sense. And then we realized that this was happening across the industry and across the spectrum. And so that's how we ended up moving there. And with stablecoin specifically, we've been, I think, among the top 2 or 3 most active within that thesis over the last, 4 or 5 years. And again, like stablecoins they're that rail that, obviously, and I've written a bunch about this in terms of how I think they're going to be used in payments. Payment innovation is the first place we are seeing that. But all of the on-chain economy cannot exist unless you have usable, workable stablecoin rails, right? And so everything we're seeing, and then we're going to continue, I think, take off in DeFi, had to, underneath it, have really awesome and really liquid stablecoin rails. And so my thesis is that like everything started at that base layer, and obviously we had DeFi summer. DeFi was has been kind of the first, one of the first product market fits, but the accelerant or the oil that you need to take DeFi from what it is today to rival, traditional financial markets, that needed stablecoins. And so that's been the thesis and the reason we've invested a lot of that infrastructure base layer, but also why we're continuing to invest up and down the stack.
Yeah, I can only emphasize that. I think that, at Scroll, we made a few bets. And like one of the bets actually that's now becoming a huge part of our strategy is ETHFi Cash, exclusive on Scroll. And the growth that we've seen there is absolutely phenomenal because it almost feels like a moment, but it's end to end. It's like now I have, like you said, the on-chain economy. You have your funds there. They're there where you want it to be. and you can have access to them seamless.
Yeah.
And the UX is just smooth. And the fees are like competitive, meaning like you're not paying like outrageous amounts to like, you know, go up and down. And they're not the only one. You see other ones like in Cast, for example, in Solana, doing a phenomenal job too. And so I can definitely see like crypto maturing in a sense, and stablecoin at the heart of it. So you know, and I'm sorry I'm double clicking on this, but I just think like it's so fascinating. You know, you're based in New York, and it gives us a unique peek into what's going on in that corner of the world. Because I do think that whereas Silicon Valley, recently been to San Francisco, all things AI. You want to do something AI.
Yep.
You just got to be there. The network effect, like you mentioned, crazy. From investors to like incubators or like engineers. You want to find your co-founder, probably going to be there. New York is becoming, for me, the hub about all things stablecoin.
Yep.
Like people I respect, look up to, but also are at the forefront. You're saying organically. I think organically, but it's becoming a gravity point. Yeah. People are just going there. So maybe first taking a step back, and then we'll go in here as well. Again, so you mentioned stablecoin rails. As Dragonfly, what's your strategy or your investment strategy maybe on all things stablecoins? How do you look at the space? Because there's a lot of noise.
Yeah, there's so much noise. 2 years ago, there was less of that, and we would look at deals, and there would be like me and like Castle Island would be like the only two like looking at these seed deals, and maybe a few others, not to discredit anybody, but it just wasn't what it is today, right? And now I look at a deal, and the velocity has picked up dramatically. I see a stable coin deal probably every day at this point, right? And on top of that, I see now a lot of traditional VCs back in the space looking at it. We all owe a lot to Stripe for basically making stable coins like sexy again, and like giving a credibility to the space that has allowed, I think, just the entire like payments industry to relook at stablecoins as a rail. It was inevitable anyways, but Stripe basically created that like, FOMO effect. And what we see a lot of is, and I think the reality is most of the money before, or the investment before, was focused on issuers. People that look like Tether and Circle and Agora and M0 and Paxos and all these guys, and where we led the seed round into Agora, but there was less so investment into like other parts of that stack, right? There was a little bit in terms of like, okay, especially back in 21, there was like point of sale, like, MoonPay, which, is essentially a PSP, and they were helping to facilitate transactions. But the systems were, frankly, and they still are in many ways, like quite clunky. And in terms of like, you don't have an iframe, like you're going to like a separate site, like there's a lot of friction involved. You see like the pull through on the funnel you see a lot of drop off during that period of time. But there was still people who believed in the space, so they were investing in those things. That kind of dried up for a while, and it was okay, well, now I'm just going back to issuers because interest rate environment is up, and Tether is like printing money and is maybe the best business ever, and like Circle's making more money, and so we'll continue these issuers. What you've started to understand is that being on chain and in stablecoins means that like a lot of the traditional payment flows like don't need to actually exist necessarily, right? And a lot of the intermediaries that exist within traditional payments, within traditional collateral management, within trading, et cetera, like that is getting collapsed. Yeah,
clearinghouses, gateways, correct. Not necessary anymore.
Right, they're not as necessary anymore, and they're not as not necessary, I think, as like some people like to say, right? Like we're not just all doing peer-to-peer transactions, but it's clear that like the value and the value accrual is collapsing, right? And so what you started to see is everybody is horizontally expanding, right? So what does that mean? Like if you actually look at like what Stripe is doing, right? Stripe is, they're a PSP, right? So they do the processing. They also have the merchant account for most of their merchants. So they're dealing with the bank themselves. They're the gateway, but they're still, someone else is potentially doing the card issuing. They're still a Visa or a MasterCard or a network, right? Like they're a piece of this puzzle, right? Well, now all of a sudden, so now Stripe, they acquire Bridge, who has all the ramps, right? They they acquire Privy, who is like the wallet or the account, right? Like they also now issue their own stablecoin, right? Yeah. So now they're the central bank, they're the issuing bank, they're the merchant bank, the merchant acquired, completely vertically acquired. And maybe the only thing they actually need is they need kind of the ends, right? So, but everything in the middle kind of is collapsing on itself. And so, yeah, you still need someone to do auth, but you don't need, you need part of Visa stack. We don't need all of Visa stack, right? Because what does Visa actually do? It relays information to a bunch of third parties who don't typically, work together, and it's hard to work together, right? Well, like if it's all on chain and everything is essentially like a book transfer, well, you don't really need all of that data transfer. You still need auth, and you still need KYC, and you need that piece, but you need a segment of that piece, right? And we're starting to see these people essentially look to become like networks themselves. And so, for every, person out there that's doing stablecoins, it's like, okay, I'm a new issuer, right? Well, they're like, expanding their product set to compete with like a Stripe or a Bridge or whatever. And you're a Bridge and you're doing ramps. Well, now you're doing virtual accounts and now you're doing stablecoin issuance, right? Or you're, a card business and you have a card, but now you're going to also do virtual accounts, right? Like what we're seeing is everybody's like expanding horizontally because they understand that to, make money and to really have that value accrue, you have to own as many parts of the stack as possible.
So are there just going to be a few at the top?
I think it's going to be like it's going to be a little bit regional, but like it's going to be, not an oligopoly, but like there's going to be, call it like 7 unicorns that like really crush it, and then like a bunch of stuff underneath. I mean, I see to the point earlier, like the amount of people I see who are like, oh, I'm starting a new stablecoin orchestrator. Like I'm competing with Bridge, but I'm the best Bridge and name your emerging market. And I have $20 million of monthly volume from like this, core customer that is like my first customer. Every single one of those businesses, like without differentiation, like they're all dying, right? And I don't want to discredit the fact that they were able to get $20 million of monthly volume. Like that's great, right? But they have no real reason to exist, and they can't compete with these bigger guys because like they're just going to move into their market, right? Because
you're giving insight into like how you look at these deals, because you're basically at this stage looking for edge, and you're essentially saying it's very difficult to find an edge now.
It's very difficult to find an edge. You have to do, I say this a bunch, but you have to do the hard things, right? And like a lot of that stuff that happens in the middle, and the things, it's flipped a little bit of the like payments innovation, Silicon Valley thought process on its head, right? Because everyone looks at Stripe. And they're like, I want to be Stripe. They're like, oh, what did Stripe do? Well, Stripe took e-commerce processors, right, and banks and the merchant banks and the acquiring, and like it basically connected the two with like 7 lines of code, and like we did like the APIs, and like that's how we won, right? And everyone looks at that and they're like, oh, that's what we need to do too. We need to have awesome APIs, and we need to connect all these people, right? And like people forget that like building an API today is so much easier than it was when Stripe did it,
100%.
right? And so like you're not doing the hard thing. Now you're doing the easy thing. The hard thing is is owning the compliance layer. The hard thing is owning the banking layer. The hard thing is owning and building a really great user experience directly for that end consumer. So you need to own. So if you need to own the ends, right? Where before you're like, oh, I'm the middle. Like I'm connecting the ends with software that doesn't exist. Well, that software exists now. Now you need to own the ends.
So you're saying go very narrow.
I think it doesn't have to be narrow, because at the end of the day, it's just that the middle piece is much easier.
Yeah.
Right. And so like you need to do the hard thing first and own the ends, and then you can take apart the middle piece. Right. Because you see these people all the time. It was like, oh yeah, I built I'm just an API that aggregates all these APIs, and then people can grow more quickly internationally. And but I'm going to charge 1 to 2 bip on top. Right. Okay. Well, like maybe, okay, if I charge 2 bips on top, and and then the ramps are charging that own the banking relationship charging 10 bips. So you're charging 20% more. Right. Why would that customer pay 20% more if this scaled player, a Conduit, a BVNK, a Bridge, could go and just connect directly with that end user, right, and charge you less, right? Because with like that type of business, liquidity and pricing is like and compliance are the things that matter, right? And people aren't going to pay 20% more for that. And so you asked about our investment thesis. Our investment thesis essentially boils down to like we believe in a lot of parts of the stack. You need to be doing something N of 1, or you need to be new. You need to not be following, because it is going to be a large companies take most, because it is the collapsing of the stack, right? And you need to be doing hard things. And if those are the things you're doing, like we want to invest in you.
So this is very fascinating, because you kind of get a helicopter view from where you're sitting, because of all the deal flow that you get, obviously all of the innovation. Then they need capital to scale or to exist sometimes. Where do you see the biggest gap in that stack?
Right now, it's still really tough to do like compliance. So, you know, one of the things that we've seen, you know, if you look back 18 months ago, and when we, us in Artemis and Castle Island put out a report basically about a month ago, a little over a month ago, that looked at stablecoin payments. And, you know, we went to 20 firms who gave us data, proprietary data, not data you would be able to parse on chain. Companies like BVNK and Conduit and Binance Pay, and like people who are facilitating a lot of these stablecoin payments. And you look at the chart and it tells you that, okay, 18 months ago, the only quote unquote like payments that were actually happening was not trading activity, but payments were like peer-to-peer, right? In the last, you know, from the time of the report, so basically in last year, the amount of things that were happening like B2B or for like other like non, like, you know, just peer-to-peer use cases was up like over 400% last year. So you look at like 18 months ago, like Bridge had basically no revenue. Right. And all of these guys, basically no revenue. A few of them had revenue if they were doing like really, really high risk flows. So they're like, oh, I'm doing like Macau gaming, you know, right. And there were a lot of people doing that stuff because, you know, in the history of payments innovation, you usually serve the underserved. The underserved is usually high risk and then you kind of cycle those people off and get more legit. But there was basically none of that, right, 18 months ago. And we saw that really, really pick up last year. And so as that's really picked up, you've seen a lot of adoption start to happen for like, you know, real world use cases with like suppliers, with like trade finance, we've seen a little bit of like obviously like payouts for like contractors and things like that. And that's really happened in, you know, call it like B2B and B2B2C and like in kind of like emerging markets. But for all of those people, and I'm rambling on this question a little bit, but I'm bringing us back around. For all of those people, because of that high risk nature of before, all of them basically at some point, and this includes like Bridge, got debanked at some point for some period of time because the bank was like, holy shit, like you were like, what is this? Like, we don't know what this looks like. Like, we don't know who these people are, and figuring, and it's really hard to get like all of the data depending on how many intermediaries there are. And so now figuring out more of a unified compliance layer to be able to, you know, figure out who the nested flows are for, to be able to figure out where the flows actually come from, how many hops they're coming from, be able to make sure that you're not actually ended up taking like OFAC sanction flows or whatever. Like, and then, being able to send that data and that KYB through every single person that this might touch, that's not really unified today. And that's one of the biggest pieces that we see in terms of getting, you know, the banks and getting like larger scale PSPs to be really comfortable with these flows. And that's the biggest gap.
Yeah, you already said it, doing the hard things. To me, when I hear this, like, again, I come from the back end insurance, I'm usually thinking about different jurisdictions, aligning different parties. Like, for me, one of the biggest things was Deal. When Deal came and sort of like unified, making payroll is not a problem anymore. And I have experience hiring from like different regions, and it's always a problem, and it wasn't a problem anymore. I definitely think that someone who comes in and solves this, just like plug and play, don't worry, and it's truly don't worry, yeah, that will take off. Don't you think that even when you say something like this, right, like compliance, and it might be boring, but I actually think it's pretty exciting. There are just certain players that are better positioned for this. Like, it's very hard to like come in as a newcomer and being like, I'm going to do this. Yep. This will probably come or be disrupted by a player that is already like providing massive KYB services right now, has like, you know, the resources, just comes in and just like flips the switch, like Stripe, saying we support stablecoins now.
I don't think that's necessarily true. I mean, you look at traditional payments again, right? And, you know, companies like SumSub, which like everybody uses now, right? Like, that was a startup, right? And it came in and just gave a much more like technically better and easier to use solution for, you know, everybody who needs to do kind of like, you know, KYC, KYB. So I think there's probably room for a solution that understands the nature of, you know, stablecoin flows and how there is atomic settlement and, you know, how they are more global, that can unify a standard, right? You know, I talked to a company recently who I know is actually trying to do this, who happens to have a lot of relationships already through their existing business, you know, for like travel rule compliance and things like that. Now, that's not a new startup, but it is still essentially a startup. It's like a Series B startup that is like crypto focused, right? And I know like Swift is thinking about this, so like to your point, but listen, if I bet against Swift, I would be right 99% of the time, right? And so like in terms of like innovating when it comes to like tech, right? Like the incentives are misaligned for entrenched incumbents like the banks or like Swift to be able to come and like offer the best solution for a new form of payment rail that might disintermediate or disaggregate them, at least in some flows, right? The incentives just aren't there. And so the history of technical innovation is that it happens by people who come at things with first principles and from the bottoms up and understand that like there is just a better way to be able to do things.
So if you look at like stablecoins now, which just said a lot of noise, I almost think that like stablecoins are creating subcategories. You have yield bearing, you already had algorithmic and fiat backed. Which product category excites you the most?
In terms of type of stablecoin?
Type of stablecoin, maybe a specific design you saw like that's a game changer.
Yeah, I'm excited about a lot of them. There's, I actually think about it a little bit in the same way that like the Genius Act lays it out, right? So they have like quote unquote like payment stable coins, right? Which is essentially like fiat backed, right? Like I mentioned before, like we led, the seed round into Agora and things like Agora and Paxos that are offering like, white labeled solutions for and shared liquidity layers and credit for kind of global payment and Fortune 500s, et cetera, companies. Like, I think that has a ton of room to grow. And I think that's super interesting. But then, we also led the seed round into Ethena, right? And Ethena has been by far and away the most successful, we'll call it like algorithmic or like asset reference stablecoin, which is the way I like to think about that. Because they aren't, it's not algorithmic in the way like Luna is, but they reference like a certain asset, right? Which is essentially the basis trade, or that's where you get your yield from. And then they reference the collateral, which is ETH or Bitcoin or whatever you put into the protocol. I think asset reference stablecoins like Ethena that have really interesting ways to potentially produce yield have a lot of way to go in terms of like DeFi, right? And so, it's a bit of, you have to think about these things in the right way in terms of they're meant to serve a different use case, and they're not meant to be intertwined with the banking system. They're not meant to potentially be used for payments, right, in the same way, but as a financial product and a derivative product, and to be able to bring innovation on chain, like they're actually incredibly useful, right? In many ways, a lot of these stablecoins are essentially, if I think back to like essentially just like deposit tokens, right? Like if you think about like the beginning days of Yearn, and then you could earn your deposit token, and you could go and use that as collateral somewhere else. Like frankly, that is the same exact meta that is happening now. We've just called them stable coins.
You're reading my mind,
right?
I think that one of the things that I mentioned after like leaving Ethena for this year is I worded it slightly different, which is like I see stablecoin as actual financial products coming from that world. It's like assets are becoming an abstraction layer for DeFi strategies, but also off-chain yield strategies that are like very, very savvy, or like even traditional, like, it's a fancy like word to throw around about delta neutral strategies, like different assets, and then just like wrapping it in a stablecoin.
Yeah, and so these are essentially like in many ways like tokenized like trades or tokenized strategies. To your point, and I think those have a ton of room to grow. There's a ton of innovation that can happen there. People need to stop pitching me on Ethena clones. Like you're just, that's done. You're not going to do that better. Please stop trying to pitch it. But there are a lot of things that you can do beyond that I think are pretty interesting, right? Like guys that like Cap Money, I think are doing something that's kind of interesting. It's really a lending protocol with like a CDO, right? But like, and then they have a stablecoin at the end. But, I think there are interesting ways to do things that are essentially financial products that have this, deposit token or stablecoin.
So are you essentially saying, the underlying mechanism needs to be really different from, let's say, an Ethena or anything else?
Yes.
For Dragonfly to be interested in like, okay, I'll have a look.
Yeah, like we try really hard not to do derivatives, right? And not that not derivatives in terms of like, and a lot of these things are derivatives, but like if you see the success of Ethena, and then you go and launch a new Ethena with like a slightly different like yield mechanism, 9 times out of 9.5 times, like 9 times out of 10, like you're just not going to win, right? Like it's it's not true that first movers have to win, and because Ethena was not actually the first mover, right? So there was UXD protocol, there was another one, I think Lemma maybe, that tried to do the same thing. They did it slightly differently with the delta neutral basis trade. Ethena came in, they tweaked it slightly, and they made it successful. It hadn't been successful before. But then Ethena was $6 billion of TVL. Guy is one of the best operators that has ever existed in DeFi. And, they kind of won that market. Well, now, like, why are you doing that now, right? Like, you're now doing it because you saw someone else be successful at it, but that market is not big enough for a second person to come and do that, right? What you need to do is think about, okay, what are the other old ideas that, maybe weren't successful, but I actually think should have PMF? How can I tweak them to emulate the success that Guy had in, like, taking that old idea that didn't work and now making it work? That's where there's a really interesting opportunity. Or if you're someone who's, really innovative and come up with a brand new idea, that's great too. I would love to back it. But don't go and look at, like, oh, the market's saturated with this other delta neutral trade, so I'll just do it slightly different.
So you're giving very unique insight, and it actually has less to do with stablecoins, but more like, the choices you make as a founder or someone who wants to be a founder. And I do want to double click on that a little bit, which is because I really love this topic, where you're like, okay, there's so basically two ways to go about winning, if I understand it correctly. And you hear this often. You either innovate, so you have a certain edge. So your edge needs to come from innovation, or your edge needs to come from a better form of execution.
Yep.
And the latter is the one I'm personally also very passionate about. So you're basically saying, and I agree, I think that what I saw Ethena do very well, but across the board, the entire team did well, is like executing. And of course, like Guy at the helm of it. And so you just mentioned something, and I just want to, like, understand that a little bit better. So you said, like, they made certain tweaks, they came from a different angle. Is that something specific which you saw? Because I also saw a lot of hustle and grit in that team. But is that something specific you saw as, like, oh, they went about doing different?
Well, so the major slight, or I mean, it's a major difference, but it was actually very slight versus like a UXD protocol, which actually raised a ton of money in 21, was that they understood that open interest on chain was very low. And the ability to scale this thing and to efficiently be able to return yield on chain wasn't there, right? And so the main thing was like, okay, well, let's actually operate with the exchanges and with CeFi to be able to do this like hybrid platform that then allows us to scale, right? And it doesn't collapse the yield as quickly, right? Because like if you tried to do this product entirely on chain, which is what the previous ones tried to do, like you had probably a few $100 million worth of capacity, and then the yields would completely collapse. Well, now you have billions of dollars worth of capacity in CeFi if you use Binance and Bybit and all these guys, and like the yields are still really really good during times of market excitement, right? When funding kind of blows out, and so that was actually the major tweak that he made, which seems so simple, right, when you're thinking about it in this context and looking back, but that people hadn't made before. And so he did that, and then it was like, okay, well, now I really understand that the TAM can be larger and it can be more scalable, and then he out executed, and those were the two things.
So, what do you think the major blocker is? So we spoke a little bit about like the opportunity, compliance, love it. You spoke about like, okay, if you're up and coming or you want to do something stablecoins, the two things you need to focus on, you either have an innovative edge, you mentioned a few protocols, or like Mon Cap, and then, or you out execute and you find a tweak it. In terms of like, again, from the helicopter view, what do you see right now as a bottleneck outside of compliance? Like maybe like as a showstopper, or is it just compliance?
No, I mean, I think compliance is major. I do think the passage of the Genius Act or some sort of reconciliation between Genius Act and the Stable Act in the House is going to be a big tailwind. I would say, and I was talking to a lot of my founders about this last week, I have been really surprised at the pace of excitement at banks and at PSPs. And it doesn't feel, in 21, you kind of saw a little bit of the headline, kind of just like they kept coming out every single day. But most of the headlines that were toothless, it's very clearly different today. And that pace has just really surprised me, honestly, right? Like Fiserv came out with their stablecoin. I actually think that's doomed to fail, but they're really trying. I had someone from Fiserv's.
Is that the biopharmacy company?
No, Fiserv is a large like payment processor.
Oh, sorry. Okay.
Yeah, and they do a lot of like core bank
Okay,
banking technology for a lot of like community banks and things like that. But the and then the PSPs are really getting involved. You hear it from the networks, Visa, MasterCard, et cetera. I think everyone actually finally accepts that like stable coins are going to happen, but they do need the regulation, and that's been a big part of it. I think beyond that, like you just need better liquidity, right? And so depending on the type and depending on the rail and depending on the location, pricing isn't always better. And oftentimes the reason it's not better is because you still have to go into fiat at the end, right? And so if there's this, I think about this a little bit in crypto card issuing. So you mentioned like Cast and Etherfi before, right? So there's two ways to do crypto card issuing today, right? There's the RAIN model. And so RAIN is actually the card issuer for Etherfi, and I think they are the card issuer for Cast in certain jurisdictions, but then they might use REAP in others. And RAIN actually settles with Visa in stablecoins. They do securitizations of their receivables entirely on chain. You can interact with a RAIN issued card and never have to touch a fiat. Right. And that if there is never fiat happening in that rail or in that transaction, then it's always going to be cheaper. Right. And then
there's no on-ramp off-ramp.
There's no on-ramp off-ramp, which is where a lot of this like FX cost comes in. But then there's like, okay, well, Bridge has a card or Bridge Stripe have a card, right? And what is that card actually? Well, that card is a wrapping of lead bank. So it has a typical bank issuer, right? Lead is the issues the card. You have to put capital into basically an escrow wallet that like locks up that capital, and then it allows you, and you can't do anything with it. It's not productive at all. Which if you have a RAIN issued card, you can continue to use the capital, can be productive. So you in Bridge's model, so you put it into this escrow contract, it gets locked up, you can swipe the card, they swap it into fiat, lead settles with their partners and Visa in fiat. Right. And so there's this extra step in transaction that causes friction and causes costs. Right. So the more that we stay on chain, the more there's a reason to stay on chain, the more there's usability, and the more that we don't have to have, and we have like deep liquidity, it just gets significantly cheaper. And then it's clearly then a better rail than, a lot of these like APMs, like Wise and, Air Wallets, et cetera.
So I can clearly see that payments excite you. And I like, I couldn't agree more with that part of the thesis where you can really see like the efficiency gains. It's almost cringe to say at this point, but it's so obvious, but it's so true. Yep. That's where the biggest win is, or one of the biggest wins around stablecoins. What else excites you that you've seen right now, or you actually haven't seen, and you're like, why is no one doing this?
I think what's very clear to me is if I move like up that stack a little bit, like what is the next use case that is going to like really take off in stablecoins? It's definitely like collateral mobility. And so like what do I mean when I say collateral mobility? Let's say you are trading with an OTC desk, right? Most of the time you are trading with an OTC desk, they're asking you to pre-fund some collateral. So I send that desk, I send them, whatever, some dollars. Maybe it's a wire. Maybe it's a wire, and they're willing to give me some credit for that wire settlement time. But they're giving me credit, right? And then they're, then I can go and trade right with them on whatever thing I want to trade, right? If all of collateral is done on tokenized rails, right? And it's stable coins, or maybe a yield bearing thing that, maybe it's a yield bearing stable coin, or maybe it's like a money market fund or something. Now, all of a sudden, instead of having to like wait for that wire to clear, right? I can move collateral. I can liquidate collateral. I can swap collateral for different types of assets atomically at any time of any given day, right? And I have capital efficiency that I wouldn't have had before. And so if you look at like, the repo market, right? If you, trillions and trillions of dollars are done monthly of repo, right? There's actually Broadridge is doing $1.5 trillion a month right now of repo on chain, private blockchain. So it's kind of more of a database, but let's imagine that someday they'll get to a public blockchain, right? The ability to use that collateral across different types of trades, across different types of assets every single day just increases my efficiency dramatically. The all of the trading shops, if you talk to them, they all believe in this, right? And now it's much easier for me to go from like a yield bearing to a non-yield bearing token very quickly. It's much easier for me to swap from I can swap from a stablecoin to a money market fund to a tokenized private credit fund. So I can decide what type of yield and risk I want to take very quickly. And I'm going to put up different collateral really easily for the same type of trade, right? All of them want to do this, all of the traditional guys. They've been worried about risk, and they've worried about integration with like their accounting and settlement systems. But we're now starting to get to the point where people can probably handle that, at least some of the more, call it tech forward ones. And the bigger implication of this actually, and what people don't realize, is that this is the biggest limitation for like weekend trading. And so people are talking a lot about like, okay, well, can we have, and NASDAQ is going to go probably 24/5, which means 24 hours a day, 5 days a week next year. And, Robinhood has after hours trading for their retail users now. I think it's four hours after hours every day, right? Well, what is happening during those 4 hours where Robinhood is allowing you to trade? Citadel is basically warehousing your risk, and they are keeping your equity on balance sheet essentially, and they aren't settling, right? And so like they are taking that risk for you, and then they are being able to like hedge out that risk or settle it, overnight as the other markets open
almost
up.
the equivalent of like off-chain. It's sort of like
Correct.
off-market, kept there, and then up or down, Citadel bears the risk for that.
Exactly, that's right. And they have ways to hedge yourself as the Asian markets open up and European markets open up. But doing that on the weekend, nobody's willing to take that risk. And so like traditional markets they've gotten to this point where they can do, call it like 18 hours a day, 5 days a week. We're probably going to 24 hours a day, 5 days a week. But the traditional markets are not at all set up and nobody's going to warehouse like a weekend's worth of risk, especially at a time where I get a tweet from Donald Trump every Sunday that moves markets 10%, right? Like it's just not going to happen. And the tech systems, the PMS systems, they're not the settlement systems. They're not set up for that. And so as you bring all of these things on chain, now all of a sudden you can move collateral, ask for collateral, do collateral calls, liquidate collateral all over the weekend if it's all on chain, and that is going to change the way we trade in traditional markets.
Yeah. We're going off script, but
Sorry.
This is great. There's two things I want to say, and I'm going to say it once, and then you can pick them. Like, it's not great interview style, but I have to get it out.
Okay.
So, immediately, the one thing I'm thinking about is an interview I did yesterday, where someone's bringing basically FX trading on chain. I have like quite a few Forex traders in my family, and one of the things is like markets close. So imagine like on-chain Forex trading becomes like huge. Like, what is the impact of that? Because like right now, a lot of Forex traders, they know like, when the budget gets handed out for like anything that's social security related in the States or whatnot, or I don't even actually know the correct reference, but when governments like hand out budget or like certain payments happen, they know exactly how to time and do swaps. They know exactly how to time or keep an eye on the market, but that's because the market's on a clock as well. And that all like goes out of the window. Now, obviously it's much smaller what happens on chain, but like fundamentals are changing then.
Yeah, well, I think it's going to change, right? So over the last, call it like 25, 30 years, trading has moved to, trading is depending on the asset class, is still very manual in many cases, but it's moved more and more algorithmic, right? And the implications of coming on chain means that markets will be 24/7, and it just has to move more algorithmic, right? And that will be easier with LLMs. Right. And that continues to be easier. And you see a lot of people trying to implement these in terms of not just, okay, well, I have an algorithmic bot that like, I back test my data, and then I, put some parameters in place, and then I let it loose, and it goes and does these things. And then as I get the data in, like I tweak the model. Well, now what if you have a agent that actually continuously tweaks the model, right? So you don't have to do it, but it's finding inefficiencies in what you do. And we'll just see more and more of that happen. And the trading firms are very hungry to see this type of trading happen. And so as the big firms start to come on chain, which is going to happen, liquidity picks up, the markets will stay open more and more. I can tell you, for instance, that there is actual conversation at the U.S. regulators right now about being able to take maybe some form of tokenized asset, if it's KYB, KYC'd, and, in like an issued security as like collateral. And if that is happening, like there's going to be a flood wave, and it is going to be 24/7. And all of our wives and our partners are going to be much more annoyed because we're going to be looking at the screens even more than we probably are. But also more trading will be done, and more business will be done algorithmically. And so it will be more about like, how do I tweak those models than it is about like staring at a screen, which sucks for retail.
Yeah, I think there definitely will be challenges, but I certainly see opportunities as well.
Yep.
I think it's just going to change, and that's very normal. Like in each wave of like, almost like when new innovation comes. I mean, like, drop shipping obviously like disrupted, the supply chain, but also like retail, or like I would say distribution a lot. Like distribution became the game, and for a lot of like shop owners, like that. To me, that was like something completely new. It's like, hey, how do you own a business? The whole concept of like, I need to own supply, I need to own a warehouse and all that stuff, but that completely changed. And here is the same. It's like, you're so used to markets opening and closing. That is already changing, but that just goes to like a radical extreme. And my first mind goes first to like forex trading, but this has an implication like on everything, like, but I actually want to take a step back. You mentioned when collateral becomes mobile. Do I understand it correctly? Do you mean like from, let's say, a user's point of view, or the one who's doing the custodial service? So
it's going to be or it's going to add the most value to probably like the desks, right? So like the OTC desk, right? Or the people who are facilitating these trades, right? The banks themselves, the custodians. What will probably happen over time, and the way traditional markets work is that like most things are in a quote unquote like tri-party agreements, right? And so what does that actually mean is like actually State Street holds all of your stock certificates and it never actually moves. State Street just moves in between accounts, right? Digitally, right? And that's what's going to
intercompanies.
Yeah, that's what's going to happen in crypto as well. We already see this. We talked about Ethena earlier. Well, Ethena actually doesn't actually post any collateral to Bybit, right? And so this was like a thing when the Bybit hack happened. It sits all on Copper. There's a tri-party agreement where all of the collateral sits on Copper, and then like Bybit settles with Copper, every couple of hours. And Copper has this clearly, if they do a lot of deribit that way with other parties and et cetera. And so like that's the way like all markets exist outside of crypto, and that's the way crypto is moving as well, and we see it now. So what will actually happen though is it'll be that there just won't need to be as much part capital, and capital will move much more quickly, right? And if capital moves much more quickly, it becomes more capital efficient, and you get more credit, and you can free up essentially, you can free up capital to do more things with it. It's GDP expanding significantly.
We're coming up on time. I didn't cover like half of the questions. No, it's actually great. I really appreciate the insight. Maybe like wrapping it up. You've been here for a minute in Canberra. We spoke about like you were on the road. I think that VCs, but especially like successful VCs, they have a helicopter view, and you kind of almost like you can see 2 or 3 steps ahead, because of all the deal flow, and you say, okay, great, you saw Ethena, you caught it, and that obviously like was a massive success. But then I can imagine like you mentioned the stack and a bunch of other things where it's right now it's lacking. We spoke about like the efficiency of payment, spoke about compliance, and I'm gonna ask you actually the same question again, and maybe hope we get like a different angle. It's like what other insight do you see right now? What's like either limiting the space or can accelerate it massively, and this is about to come?
Answer it a different way. What I would say is that I think that the rest of the on-chain economy, so we've been talking about things like real world assets coming on-chain for a long time. Frankly, and not to be rude to anybody who's out there, it's still pretty de minimis in terms of like size and use case. The acceptance of stablecoin rails across different traditional counterparties will be the catalyst for all of these other tokenized assets to now have their stablecoin moment, essentially, right? And I think especially around like on-chain credit specifically, right? We're talking, $13-14 billion of real-world assets if you include figures like Helix, which is the vast majority of that. And you're talking 260 billion of stablecoins, right? That delta is going to collapse as stablecoins get accepted. stablecoins will continue to grow, but credit is a much bigger market, and that will grow much more quickly.
Rob, thank you so much. It was definitely insightful, and I'll say it on live on record. I hope to get you back, because I definitely think that as we progress in the industry, it's very insightful. And I think for founders as well, not just like retail or anyone who wants to learn about stablecoins. I think if a founder looks at at this session right now, they could tell, like, okay, if I want like a VC, how do they look at the space, and how can I build my edge? Like, I take the two things away: better execution, like an edge, having an edge, and better execution, or like an innovative solution. Thanks so much for your insights.
Yeah, thank you.